Hello, welcome back. We said in this video we're going to cover the journal entries specific to a note receivable. So first we have to create the note. We said these are the three common situations in which a note would be created. Okay, so let's look at an example. Here is the promissory note that I showed you earlier, right? So here we have an individual or a company that owes company XYZ $10,000. So let's say that this had to do with a purchase. So we are company XYZ, or company XYZ. We sold to company ABC an item for $10,000. $10,000. Okay, so ABC has to pay us back, right? We sold them a good for that. They're promising to repay us, but since it's such a large amount and they want 2 years to repay it, we set up a formal note. So on the day where this sale occurred and when ABC needs to promise to pay us back the $10,000, January 1st, we did the following journal entry for company XYZ. We would have established the note, so note receivable. The note receivable is always recorded at the principal, $10,000. And this was because we made a sale. I know it's not too specific here in the note, so I'll just say we sold a good, sale of good. Okay, so sales revenue. And then if we knew how much the cost of that good was, then we would do the second entry, cost of goods sold and inventory. Let's say for fun it was $8,000 was our cost. Okay, so this is to record the sale, to record the cost of sale on January 1st. So that's the first journal entry, and we saw that one in our last video, right? Sale of good. Now, what's different that we haven't had before with an account is this interest of 14%. 14%, and that's the annual interest, and we're going to be paid that each year for 2 years. Now, the repayment of that interest does not happen until the maturity date. So we don't actually get the cash for that interest until 2 years later. But don't you remember revenue recognition, right? So 2019, it's established, 2020, and then 2021. So 2 years later, this is when they owe, this is the due date. On the due date, the company has to repay, so company ABC has to repay $10,000 plus 2 years worth of interest. But revenue recognition says if we've earned something, we need to record it periodically. So after 1 year, we've earned 14% interest of the principal. And then at the second year, we've earned the other 14%. So at the end of 2019, December 31st, when we make all of our adjusting journal entries, we're going to have to record one for the interest related to this note receivable. So your accounts will be interest receivable, because I mentioned we're not getting paid until the due date, but we do have the right to receive it, the legal right. We've given them already 1 year of free time. Well, it's not free because we're charging them interest. And then the offset is interest revenue. And you'll say to accrue interest on note receivable. And remember that word accrue from chapter, what was it, 4? When we accrue revenue, we always debit a receivable, we always credit a revenue. So we're following those same rules that we learned back then. All right, let's figure out the amount. Your formula is principal times interest times time. The principal is $10,000. The annual interest rate is 14%, and it's been 1 year. Okay, so math that out. You should get 1,400. So that's your journal entry that you will make December 31st, 2019. In 2020, December 31st, you need to make another adjusting journal entry to record the other 1 year's worth of interest. It's going to be the exact same journal entry. Interest receivable, interest revenue, 1,400. Okay? To accrue interest on note receivable. Easy peasy. So we have our journal entry to create the note and to record interest. Now, January 1st, 2021, company ABC owes us the $10,000 plus the 2 years worth of interest. So let's see what that would look like. 2021, January 1st. To record payment of note and related interest. This is also called honoring a note. When a customer pays at the due date, it's called honoring the note. So if a customer doesn't pay the note and interest at the due date, it's called dishonoring the note. Just in case you see that term in the chapter, now you know what the heck it means. All right, so we know on this date, we're finally getting cash. Hooray. The cash is going to be the principal plus total interest. We'll figure out what that is in a minute, or you could probably figure it out already. It's the $10,000 plus 2 years worth of interest, $1,400 plus $1,400. So that means our total cash is going to be $12,800. All right, that was your principal of $10,000 plus 2 years worth of interest. Okay, that's how we got that. What is that customer paying off? They're paying off their note. The note's always recorded at principal. We got to get it out of there, so we're crediting it for $10,000. Now comes the tricky part. What's the other account? In this example, let's look at your T account for interest receivable. Interest receivable in 2019, $1,400. Interest receivable 2020, $1,400. So it's a total of the $2,800 of what they owe. Now, on the due date, that customer is paying it all. So we need to get rid of this receivable. They no longer owe it to us if they're paying it. So we need to credit interest receivable. Okay, so hopefully that makes sense. We have already recorded the interest revenue and we matched it to the right period following that time period and matching principal that we learned about. So we've already recorded the revenue for 1 year in the first year, revenue for the second year in the second year. So there are your journal entries. So to recap, there was 3, 1 to create the note, 1 to record interest, and then 1 to record honoring of the note at the due date. All right, go ahead and try one now relating to notes receivable. Go ahead and try EA 14 on page 626. Give it a try. I'll post the solution and then you can compare just to make sure you feel comfortable with notes receivable, the calculations, and the journal entries.